It's not about picking stocks. It's about picking the right portfolio.
In your thinly veiled critique of investment policies pursued by Harvard for a brief spell starting in 2017, you noted that Harvard's large asset base relative to its peer institutions constitutes a handicap in generating superior returns. Given the obvious economies of scale in money management, doesn't Harvard's relatively large asset base constitute an unqualified advantage in its pursuit of winning returns?
The Harvard endowment today is, we'll call it $53 billion. It's still a lot bigger than the Yale endowment, although the gap has narrowed, right? So when I said Harvard has a disadvantage by dint of its size, which was the basis of this question that I'm answering, relative to its peer group, which it was seeking to compete against explicitly in the policies I critiqued from this room the other day. It's like, why would you do that?
Yeah.
Now, go to the next slide, Eric, to finish this maybe long-winded answer to this second question. This is really interesting to me, Taylor. The headline is, why do these clients hold identical portfolios? And what you're seeing is a series of bar graphs which give you a snapshot of how reliant each of Harvard's operating divisions, what are known up there colloquially as tubs, every tub on its own bottom, how reliant are they on endowment income? On the far left, you see the Radcliffe Institute, which is essentially a think tank today. On the far right, you see the business school and the public health school. Radcliffe draws about 80% of its budget from its endowment. These are annual endowment transfers.
Gotcha.
The analog in the family office context is, well, the family has a lifestyle to support. We need to sell something in the portfolio or use dividends, interest, and rent to cover cash flow needs.
Yep.
Okay, so Radcliffe is 80% reliant on such transfers. And the business school and the public health school, for various reasons, business school, it's kind of obvious. They have a lot of executive programs. They generate a lot of cash flow. It's only 20% of the business school budget. However, what Harvard has done is they've taken, because these are restricted endowments in many cases, right? They've commingled all these assets for investment purposes, right? All of it, it's managed very ably, I think, or I should say as ably as one can do by my friend Narvarkar, who was also a member of my board at TIFF, and Rick Slocum, who's the CIO. They're doing the best job they can with an excessively large asset base. So what Harvard has done is they've aggregated assets to, I think, an imprudent extent. They don't need to do this. Right? They could split it up into 2 or 3 different risk pools. And I think for a whole bunch of mostly behavioral reasons, they'd be much better off. Like when Bloomberg would call them, every year and say, okay, we got Yale's number, what's your number? Creating that kind of horse race, that FOMO thing. They could say, well, we don't have a number. We have 3 numbers. We have 5 different risk pools because our clients, the various operating divisions, like if you were at Goldman Sachs or Merrill, financial advisor, and families, let's pretend, one family came in for a 10 a.m. meeting and said, we're 80% reliant on our portfolio to support our lifestyle. And in the afternoon, you met with a family that said, well, we're only 20% reliant. And you give them the same portfolio, at the very least, it raises questions.
Yes.
I mean, at worst, it's like professionally.
It should raise questions.
Professionally negligent.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.